Hi, everyone, and welcome to today's webinar featuring Adamy Valuation, where we will talk about charitable planning strategies with business interests. My name is Liz Brigson. I'm so happy to be here as your host today and also your co-presenter, and I really hope to help you get the most out of this presentation today. So first of all, I'd like to just walk you through a few things about the webinar and how to use GoToWebinar. So we would love to hear from you. You can ask questions, share your feedback and your experience using the GoToWebinar questions pane. So if you want to go ahead out there, say hi and let us know where you're joining from. We'd love to hear from you. So hi to Victor, who joined early and said good afternoon from Bohemia, New York. It's great to have you here, and we'll be keeping our eye on that questions box throughout the webinar today. You can download the handouts from the GoToWebinar control panel, and those handouts just feature the slide deck. So if you want to save that for future reference, share it with your colleagues, we'd be happy for you to do that. Today's webinar is 1 hour. That means we'll launch 4 polling questions. As long as you respond to 3 of those 4 polling questions and remain logged in for at least 50 minutes, you'll qualify for CPE credit. And you can access your CPE certificate from your Incorsa dashboard 1 hour after the conclusion of the event. If you have any questions after the webinar, you can reach out to us at support@incorsa.com. I'm on LinkedIn. I would love to connect with you, and I just want to share a little bit more about my background in context of the presentation today. So as many of you know, I lead education and partnerships for Incorsa. I really enjoy this role and getting to interact with all of you and share solutions and introduce you to people who I think can help benefit you and your clients and just help you get the most out of this professional life that we live. And I am also part of the Adamy Valuation team. I joined the Adamy Valuation team almost 6 years ago, so I've been working with them for quite a while and just really have found that the team is the best group of valuation professionals out there. So today, I get to introduce you to one of my colleagues and share a topic that I am completely fascinated by and have really enjoyed working with. And so I'd like to introduce you to my colleague, Kaylee Simerson. Kaylee is on the Adamy leadership team, and I got to know Kaylee, wow, probably 4 or 5 years ago when Kaylee joined Adamy. We immediately hit it off, and we really connected on everything from family to fitness and to business valuation topics very quickly. Kaylee, I remember admiring how you really rolled up your sleeves so quick coming back from maternity leave, and you really dived in to learn how the firm operates. You were studying for the CVA exam, and you also jumped right into project management. And over the years, I've seen you continue to take on more responsibility in the firm. You were promoted to director, you were invited to sit on the leadership team, and you have brought excellence to Adamy's recruiting and training processes, all while building your technical expertise across several key disciplines, with charitable giving being one of them. So can you say hi and share with the audience today more about what led you to the field of business valuation and what draws you to charitable giving specifically?
Yeah, thanks, Liz. Hi, everyone. So happy to be here and talking about this topic today. I, like Liz, and am very fascinated by this area specifically and really enjoy working in it. Business valuation specifically, what drew me to business valuation? So many things, really, but you know, the opportunity to work with attorneys and CPAs and be able to strategize on ways for our clients on how to just really serve their needs and in the best possible way. But then also getting to work directly with business owners and so many different purposes that I get involved. But you know, I get to work across various number of industries and really get to work side by side with business owners and understand, you know, what makes their business tick, and hear stories about how they grew their businesses from the ground up, and really just get to hear some fascinating stories. And I love that opportunity to not only work alongside them but learn from them as well. And then particularly charitable giving, this is certainly an area that I'm very passionate about. And what I have found working in this area specifically is that generally speaking, that, individuals that are charitably inclined are just naturally really generous people. And when you work with these people that serve in that way, that generosity is really at the helm of, how they lead a company, how they treat others in their company. You just typically see not only really well-run and profitable companies, but the culture that they've created within their own teams really just shines through. And I think there's a natural translation there for the companies that are charitably inclined, and ultimately how that translates over to a successful business operation.
I agree with you, Kaylee. Thank you so much for sharing that. And Adamy is truly a special place. We really care about the experience our clients have, and we desire to execute projects with excellence. And it's in our roots, it's in our core values. And Kaylee, do you just want to quickly highlight these values and what makes our team unique?
Yeah, absolutely. I think client experience is certainly one of the main things that is unique to our team, and it really stems from a group of people that really enjoy their jobs and enjoy the people around them and are passionate about the business valuation profession, which is necessary, right? Because business valuation is an ever-changing profession. It's because it's subject to the continuous changes in the accounting standards, in tax policy. So it's really important for our team to remain intellectually curious, and so they can deliver quality work products that our clients can depend on. And so when you enjoy the work that you do and you're eager to learn more, and that intellectual curiosity or that want to continue to be lifelong learners is really what drives you, then it just speaks to how we serve our clients. And we do it in a way that is collaborative and inclusive, and working with us is certainly an experience, and is something that we take a lot of pride in.
It's a great group of people, and certainly it's been awesome just to see the firm grow and the training processes develop. And so we're excited to be here to talk about charitable giving with business interests. So I want to just quickly highlight those learning objectives that were listed when you all signed up. So first of all, we're going to talk about key considerations related to asset-based gifting. We're going to talk about what asset-based gifts or complex gifts are. We'll share the advantages of proactive planning. We'll also talk about what to expect when obtaining a business valuation in connection with a charitable gift. We'll share a few stories, and we'll talk about the role of donor-advised funds. So we do want to launch our first polling question for all of you. And for those of you in the audience who are joining us, we'd love to hear from you. How familiar are you with charitable planning with business interests? So would you consider yourself to be very familiar, somewhat familiar? Maybe this concept is mostly new to you. Maybe it's completely new to you. And that's great. No matter what you're responding, we hope that you'll come away with some ideas that you can put into practice, share with your clients. And if you are responding that you are very familiar or somewhat familiar, please share your experiences and the things that you've encountered throughout your career as well. We always enjoy hearing from you in the audience and knowing what you have to say. We're going to go ahead and close the polling question down. We have a nicely distributed bell curve here where 2/3 of our audience is in that middle of somewhat familiar and mostly new. And then we have some of you who are very familiar and some of you who are completely new to the concept. So welcome. We're so glad you're here. Moving on, we're going to, again, the primary focus of today's conversation is going to be around charitable gifting of complex assets. So before we go any further, Kaylee, can you start by explaining what a complex asset is?
Yeah, absolutely. So complex assets are really just non-cash or illiquid assets. And so common forms of complex assets are business interest or real estate. Now, like Liz said, for the purpose of today's conversation, we are mostly focusing today's strategy around business interests specifically. You'll also hear us, so business interest, this is a strategy that ultimately works for C Corps, LLCs. So you may hear us refer to stock, membership interest, or business interest. We use them all interchangeably. We're not going to get into kind of the details of all of that, but just know that throughout today's conversation, we're going to use those words interchangeably. But business interest is the focus and is the most common complex asset.
And what is the benefit of gifting complex assets as opposed to just gifting cash or liquid assets?
Yeah, there's really two primary benefits, and it comes down to availability of assets and then tax incentives, or better said, the tax efficiency that's available to those assets. So, I heard a statistic a while back that over 85% of charitable gifts come from cash, but over 90% of the wealth that's held in assets, but over 90% of wealth is held in assets other than cash. So this means that there is a significant potential for charitable donation through other forms of wealth outside of cash. So that's speaking to the availability of assets. There's more wealth tied up in assets other than cash. And then the second benefit there is really the tax incentive. So a cash donation, it does provide an income tax deduction, but a gift of a complex asset provides an opportunity for not only that income tax deduction, but it also provides the opportunity to avoid capital gains tax, which we will build on this throughout the conversation on how exactly you do that. But there's two mechanisms for tax savings. So it's that income tax deduction as well as avoidance of capital gains tax. So I can highlight the structure at a very high level before we get into the details of how it works. But ultimately, the strategy is that a charitably inclined business owner would gift a small minority percentage of a business interest into a DAF, so that's a donor advised fund, before any formalized sale agreement is entered into. Then, once the sale is executed, the DAF, or the donor advised fund, who now has interest, ownership interest in the business, they get the liquidity from the sale proceeds. So from there, the DAF can direct the funds that they received through the sale proceeds to put to work charitably. So there's a lot of flexibilities there. We'll get into that a little bit more. But the power of the strategy, like I said, ultimately comes from the capital gains that are avoided by the business on the portion of stock that's donated.
I think that's a great overview just to set the table for what are complex assets, what's the benefit of gifting them. And also I like that statistic that you shared too around the percentage of wealth that is in assets other than cash, because when we think about who can benefit most from these strategies, a lot of that would be wealth that's in privately owned businesses. And so we know that charitable giving with business interests isn't for everyone, but we're not saying that charitable giving is not for everyone, of course. We're just specifically talking about business interests. And this is specific to individuals who have companies, who have, as Kaylee alluded to, potentially an exit on the horizon. And there's some good tax advantages as well as being able to tap into that wealth. And along with the statistic that Kaylee had shared, there is another statistic I'd like to share with you from the 2014 Family Owned Business Institute survey. This is put out by Grand Valley State University Family Owned Business. And it shares that 90% of family businesses engage in philanthropic giving. So when you think, Kaylee, about your statistic around the amount of wealth that's in illiquid assets, and then how generous family businesses tend to be, then that is really, this is a strategy that if family-owned businesses are part of your client base, this is a really important characteristic to recognize and to support. Charitable giving with business interests is a matter of timing, a matter of net worth, the size of the business, and of course, a matter of interest. And so what does that look like? Companies' values can range from a few million and up. The case studies that are most readily available tend to focus on companies with fair market valuations of about $10 million. And of course, you can imagine that just provides a really good round number for talking purposes, for calculation purposes. But that's a good benchmark. I think you can do these types of charitable strategies with smaller companies. And of course, the size, there's no limit on the top side. But you're probably looking at companies with at least a few $1,000,000 in valuation. Of course, the desire to give generously is something that we'll hit on as a theme throughout this webinar today, because the desire to give is really fundamental to taking advantage of a strategy like this. And it's also really helpful to have the family, the organization on board when you're talking about giving a gift like this. It's pretty substantial, and so it's nice to have everyone on board. And as an advisor, having strong relationships with your clients, knowing their business and their life goals, what type of succession planning they have in mind, these are all important aspects of being in a position to best recognize how you can support your clients. And Kaylee, you're working with attorneys and CPAs regularly. What should advisors be listening for when they're talking with their clients and maybe thinking about something like this, or maybe even before it's come up? What should they be listening for?
Yeah, as Liz already stated, that being charitably inclined is really fundamental to the strategy working, and we'll share some stories as to why that's so important to be kind of at the helm of what's driving this strategy. But listening for things in that way is that I'd like to give more, or looking for different ways to be able to put their money that they've worked so hard for to work in a charitable way. Of course, I think those are some natural things to listen for. But in terms of selling a business, are they talking about, okay, I'm getting ready to, I'm getting tired, I'm looking to start slowing down, I think I want to discuss what transitioning my business would look like. I'm open to selling my business. So all of those, I guess, comments or discussion topics are certainly things that I would ask some more questions around. And if they are charitably inclined, then this is a strategy that I think is worth being shared, at least from an awareness perspective. And then we can always dig deeper later, but certainly focus on anything charitably inclined related, or potential of selling the business or creating some sort of path to liquidity, which will also be a theme of what we discussed today.
So those are good things to listen for, kind of those openers to a bigger conversation. And as that conversation continues, I can imagine a business owner might say, is this a new thing? Like, how new is this? If they haven't heard of it before, they probably want to know the background a little bit to know how common this is.
Yeah, no, it's not a new strategy at all. It's been around for decades, but in 2019, the IRS guidance made it much more clear and created a lot more awareness around the strategy. So it's certainly been increasing in popularity and use, but really the real driver behind it being more commonly used as an exit strategy is really about the volume of generational wealth that is tied up in our baby boomer generation that is retiring right now. I've seen different statistics on this, and it ranges, but overwhelmingly, the majority of private businesses that are held by the baby boomer generation, it's the large majority. So that is why it's becoming such a more popular exit strategy here, and it's certainly growing in awareness.
And Kaylee, you're going to share a few examples. Do you want to touch on a couple examples of what that would look like, how that can be used? And so that way, those members of our audience today who have clients who are charitably inclined can think about like a few different scenarios on like when this could fit. Of course, with the sale of the business being the one we'll focus on today.
Yeah, the sale of the business is certainly the exit strategy or the path to liquidity that is most commonly used. But I've seen a number of different exit strategies, or not even necessarily exit strategies, but there is a path to liquidity. So I have a couple of clients that are fast, high growth companies that are gearing up for the potential of an IPO. And so, of course, that does create some level of a path to liquidity over the near term, although that's a little looser than a defined sale, but it certainly creates a path to liquidity that could make this a viable strategy for that situation. And then another really unique one that I've done with a couple different clients actually is companies that have rewarded their employees through minority interest ownership in a company, and not an ESOP. Now they seem to kind of mimic the attributes of an ESOP, but these are not ESOPs in this case, or employee stock ownership plans. But what they've done in those situations is there's buy-sell agreements that are put in place that ultimately define they ultimately create a market for that stock. So if the employee were to leave or to retire, they would have the ability to sell that stock back to the company. And so that creates a market for the stock. And it's generally done through a buy-sell agreement. And it's done through a predefined formula on how that stock is valued. But if your company has something like that set up, or if you're early on in the process and have the ability to set that up, that certainly creates a market for that stock as well. And that's ultimately what we're looking for here. The strategy, and we'll get into how the DAF works and why this strategy is so important, but ultimately there needs to be a path to liquidity. In order to put that money to work charitably, there's got to be a liquidation event. So these are a few different ways that you could ultimately create liquidity that can be used in a charitable way. So, pretty standard to, the scenarios can get pretty creative for sure.
Thanks for highlighting that. So let's talk more about donor advised funds, or as we're referring to them as DAFs. This entire concept centers around the use of a DAF. So let's talk more about that. Donor advised funds, they are charitable strategies for giving. They've been growing rapidly in popularity with an estimated $141 billion in assets, according to a 2018 Giving USA study. So basically, as Kaylee is alluding to, a donor advised fund, it's a charitable account that a 501c3 sponsoring organization, they have legal control while the donor retains advisory privileges. So Kaylee, as we're talking about using that donor advised fund, do you want to talk a little bit more about how it functions and why that's a necessary part of these strategies?
Yeah, the main thing with a donor advised fund is it gives you the vehicle to be able to hold these complex assets. As you can tell, and you know, by nature, they don't have to be overly complex, but there's certainly some complexities to these assets, and they are set up to be able to hold these assets. So that's why they're necessary to the strategy. Most likely say a community foundation is not going to be structured to be or set up to be able to hold these types of assets. Typically, community foundations are generally geared towards cash or marketable security donations. So that's why a DAF is very necessary to the strategy. But it doesn't mean that using a DAF limits your flexibility at all. So there's still a ton of flexibility. You can determine the timing of a gift on, how that's dispersed out, who it goes to. You have flexibility of separating, maybe giving to a few different charitable organizations, and you certainly have control over the timing. So it really just depends on what DAF you use, but they are certainly a necessary component to the strategy because of the need to hold that complex asset for a period of time until there is that path to liquidity.
And as you're saying that, it's reminding me of a conversation I had with the institutional giving department at a higher educational institution. And that was exactly the conversation, is there were certain types of assets that they could handle and receive, but then when it came to something like a business interest, to really make that work smoothly, both for the giver and for the college, they needed to have like an intermediary, which is exactly what that donor advised fund is set up to be. It has all of the tax advantages for the deductions, but a little bit more sophistication in administration in handling those complex assets. So that's, I think, a really good overview. We'll continue to talk a lot about donor advised funds, about DAF. So we just wanted to provide a brief overview about how they function and what they are. Again, like, they can be used for other purposes than what we're talking about today. But for the purposes of charitable giving with business interests, that's really, I think, what's most important to know about a DAF. So Kaylee, anything you want to add before we move on and talk about what it might look like for someone contemplating an exit?
No, I think that's pretty good on the DAFs. I think we can move into the next slide.
That sounds good. And they're quite fascinating. And in the appendix, we have shared 3 donor advised fund profiles. So you can learn a little bit more, and of course, visit their websites where there's a wealth of knowledge more about the intricacies of how they work and what it's like to work with one of the popular DAFs that are out there. So let's take a look at how this can play out for a business owner contemplating an exit. So if we start here in the blue box in the center, as the sale process is taking shape, a charitably inclined business owner might be thinking about giving some portion of the sale proceeds either to a ministry or a charity. And around the time that a letter of intent is in place and the process is moving toward a draft agreement, a gift of stock might be considered. And so the blue line here that you can see that goes right across the screen, this is important. And this represents the period shortly before the deal closes. We're going to talk more about the timing factors a bit later on, but we really wanted to visually show how the timing of the gift and the taking place before the sale is critical to achieving both the maximum giving impact and tax advantages. So this is kind of just a bit of a view here to see the sale process, the letter of intent. On the left-hand side, you have the gift of the business interest or the stock to the donor advised fund. The line represents having that gift happen prior to the sale. And then we'll talk more about liquidity, as Kaylee's highlighted, for the donor advised fund after the sale. So Kaylee, can you talk us through a little bit, who are the advisors who you are generally involved in this type of process?
Yeah, as we have highlighted here on the screen, there's a few typical advisors that are involved. Of course, your attorney, and there's potentially a couple different types of attorneys that may get involved. Commonly, especially when the larger deals come together, where we see tax attorneys, your corporate counsel, as well as the transaction attorney. You know, it's very possible that that is completed with one individual kind of advising on all elements of that. But I've seen it in all directions. So definitely an attorney that is familiar with this concept, and then your CPA. CPA is going to be heavily involved, obviously, from the tax side. Likely a financial advisor is also going to be involved, especially when it comes to deciding how you want to put your money to work charitably, and you know, what's left over and how your whole financial picture looks. And then there's the qualified appraiser, and we'll touch on that in a later slide on how ultimately the qualified appraiser comes in. But it is important to have all of these advisors at least aware that this transaction is happening and the gift is going to happen. There are some elements that are really important in terms of timing that all four of these parties, your attorney, your CPA, your financial advisor, and the qualified appraiser, all will have perspective in. And so to make sure that you have a successful gift and a successful transaction, it is important to have all those parties involved from the beginning. Now,
Absolutely.
I do really want to reiterate the fact that Liz commented here on that blue line being really significant. And like she said, we'll jump into a little bit later on why timing matters so much. But that gift has to happen prior to the sale. So typically it is happening at the stage of an LOI. So a letter of intent, the sale has not, there's nothing formalized, there's nothing binding on the sale. It does have to be in that letter of intent stage. So that is a really important step here.
So I think now would be a good time if we look at the advantages of planning the gift in advance of a sale. And I want to share this case study that the Signatory has put together. The Signatory is one of the donor advised funds, and you can read a little bit about them in the appendix. But this case study illustrates the impacts on the funds donated to charity and how the timing of the gift impacts capital gains. So there's a lot of numbers here. I'm going to do my best to walk you through this and see if my little pointer will help me do that. So Kaylee, are we seeing any? Oh, the pointer may or may not be giving us an assist here.
Are we? Now it is.
That on the screen? Okay, yeah. Good. I wish it was blue and not red, but I digress. So you can see where the case study is representing a company with a fair market value of $10 million. Again, a nice round number. And the gray bars illustrate the scenario of selling the company and then making the gift afterwards. The teal bars are highlighting the scenario of making a gift first and then selling the company. So in the first scenario, which we come down here, which is sell, then give, the capital gains tax would be $2.5 million. You can see that over here. And that's assuming capital gains tax of 25%, a nice round number, multiplied by the sale price of $10 million. So in this case, we're looking at a gift of $1.5 million. That could be the gift of stock or a business interest worth $1.5 million. And if this is made after the sale, the income tax savings essentially would be $555,000. That's just assuming an ordinary income tax rate of 37% multiplied by the gift of $1.5 million. So thanks for your patience in walking this through with me, but that's the scenario of you sell the business and then you give. Now here in the second scenario, with the gift being made first, you can see that the gift is raised to $2 million or 20% of the ownership interest. And that reduces the capital gains tax because we're now looking at capital gains tax on $8 million rather than the full value of $10 million. So then your capital gains tax is $2 million compared to the 2.5 million that you could see previously. And then the income tax is that you're saving $740,000 in income taxes because you're giving more. So in the end, the charitable contribution is $500,000 higher. The capital gains tax is $500,000 lower. And then there's income tax savings of $185,000. So this is just a good snapshot, of course, depending on the type of business interest or the tax rates. I mean, it can get more complex, and we can see that there's a lot of different ways this could play out, but this is just a nice snapshot that really does show that you can have more of an impact financially and have more tax savings by doing the gift beforehand. And Kaylee, what reflections do you have when you walk through an example like this?
Yeah, to me, this is one of the most powerful slides to show the impact potential here of this strategy. What Liz laid out here, that sell then give, that's the most traditional way of giving. You sell your business, you have all of these proceeds, and now you're going to give. And what that just means is, the gift, 20%, it's the same, but by doing it in a different way, changing the flow of which that happens, you're able to direct more money to charity and save on taxes. So ultimately, you both end up ahead. The charity ends up ahead. You end up ahead in terms of net proceeds because of the income taxes that are saved here.
And that's really what tax planning is all about, right? I mean, this is exciting to be able to bring a solution like this to see the impact on both the charity and the giver.
Yeah, absolutely. And then another important perspective to consider is that the business interest that has been held for a long period of time, particularly a company that's grown over time, they stand to have a significant level of appreciated value that's going to be subject to that capital gains tax. So avoidance of capital gains tax on the portion of that's a portion of appreciated value is really what makes this strategy so powerful.
So when we layer on the amounts that we just talked about onto our little diagram here, it's just, we've added the yellow boxes, right? So now you can see the timing of the gift along with the capital gains taxes avoided and then the income tax savings. And I wanted to draw your attention to that yellow box on the right-hand side above the line. So this is an important point that we'll address shortly. The selling price at this point is expected. And Kaylee, I know in a little bit here, you're going to talk about how the certainty on the selling price and the transaction itself has some consequences on the valuation and the discounts. So that's one point. But for now, we want to call your attention down to the blue box on the lower left and address the path to liquidity. Kaylee, you've talked about this a little bit already and how important it is that the donor advised fund obviously needs the liquidity to make an impact to charities. And generally with an exit, the buyer of the company is going to buy out the interest or stock from the donor advised fund at the time of the sale. And at this point, Kaylee, what would be important for a client to know?
Yeah, so based on this illustration here, what this would look like is from the buyer's perspective, they will actually be buying interest from the prior business owner, but from the DAF as well. So in this scenario, they'd be buying 80% from the seller and 20% from the DAF. And one thing to note, like we're just using this for rough terms and for illustration purposes, but often we see gifts that are fairly small. I mean, 2 to 3% is a common gift size that I see. So certainly do not need to gift 20% of the company to make the strategy work.
That's a great point. I'm really glad that you highlighted that, because we'd certainly not want any of you to walk away and feel like there's a $2 million threshold here for giving. So thank you, Kaylee, for highlighting that. It does really lead well into our next polling question. So the polling question's up on your screen. And the question is, how frequently do you discuss charitable giving with your clients or within your company? So is this something that you're talking about on an ongoing basis, maybe something quarterly or annually? Maybe it depends on the client and the need. Maybe not at all, or maybe in the future you'd like to introduce this concept. And I want to draw attention back to those donor advised funds again, because all three that we've highlighted in the appendix, which will be National Christian Foundation, the Signatory, and Fidelity Charitable, they offer a tremendous amount of resources to help charitably inclined families and businesses plan for things like this. And I think that's really cool, just to draw on some resources if you are having those conversations with your clients, either on an ongoing basis or even quarterly or annually, and you're looking to provide some more substantive discussion points and some more longer term thinking and planning for those discussions, donor advised funds are going to have some really fabulous resources for you. We're getting ready to close the polling question down, and we'll share those results because we all like to just kind of get a pulse check to see how this ranks for everyone. So 20% of our audience today are having these conversations at least annually. Just under a third of you are really saying it depends on the client and the need, and that makes sense. And almost 10% of you want to introduce this concept. So that's fabulous. And for those of you who responded not at all, I'm guessing that perhaps you might be in an industry role where you are working inside a company. But I'm really glad that you're here and that you want to learn about these strategies, and hopefully you'll have something that you can tuck in your pocket and save for the future, because as you can tell, Kaylee and I really find this to be a fascinating topic. So we'll close the polling question. And now we will, Kaylee, we've talked about liquidity a few times. So I think we finally get to talk a little bit further about liquidity, right? Do I have to be selling my company? Are there other ways? So for those of our friends today who have said they're having these conversations regularly, if someone's having this conversation, but their client isn't getting ready to sell, are there alternative paths to liquidity?
Yeah, and I did briefly touch on these on the beginning, but I'll just reiterate them real quick. Going back to the purpose of the DAF, the DAF's purpose is it's a vehicle to get these funds or monies, to get them to work charitably. Their purpose is not to hold assets for the long term. So that's why we keep focusing on what is that path to liquidity. That ultimately has to be the focus to make the strategy work. And selling a company, of course, is the number one strategy, the most commonly used strategy that we see. But as I mentioned, the potential of an IPO is another strategy. That redemption policy, or the buy-sell agreement that I talked about in the beginning, that was kind of a creative way to create a market for the stock. So there's no transaction happening at all, actually. It is just a buy-sell agreement that is put in place that has created a market for any stock that in the cases that I've seen, it's for employee ownership, but that also does not have to be. It could be a scenario of where there's multiple owners in the ownership group, and there is this defined formula on how those owners or members exit. That also works. That creates a path to liquidity for that stock. And then another way, Liz and I talked about this, and this is a scenario that we know has been used. I have not personally seen it on any of my clients, but if you have a company that pays out a high level of dividends, so ultimately it is creating liquidity for the DAF. That could potentially work. That would be something that you would want to talk through with the advisory group and the DAF sponsor specifically, if that is something that they are set up to handle. I would suspect that they're still going to want to have some sort of exit plan, because it's not going to be their goal to hold assets for the long term, even if they're paying out large volumes of dividends in the interim.
Awesome. Yes. So thank you for highlighting again a few of those other ways in addition to the sale that this can be, a donor advised fund can be used. And thinking back to where we left off with our diagram, one of the elements that we had was this qualified appraisal from a qualified appraiser. And that's where we come in. So let's talk about the requirements of a qualified appraiser. That would be the business valuation professional. And Kaylee, so I guess a question that you shared with me that you hear asked sometimes is, why do I need to have a valuation when I already have an LOI in place?
Yeah, good question. Well, the IRS requires it. So like Liz mentioned, the IRS requires a qualified appraisal to be completed by a qualified appraiser, sorry. And it's attached to the tax filing. And the appraiser also has to sign what's called Form 8283. And this goes along with your tax filing. The CPA fills out the top portion that identifies the gift and the tax deduction, and the appraiser comes in and reviews that and ultimately attests to the fact that what we valued is in fact what was gifted. And so just because someone so charitable giving specifically in this strategy is unique. So just because someone is familiar with business valuations or has the ability to perform a business valuation doesn't necessarily mean that they are a qualified appraiser. There are certain credentials and requirements of the IRS that is required to be a qualified appraiser. And then beyond that, there are a lot of nuances to a qualified appraisal and what is necessary to be included to be qualified. I think one important concept here to understand, and we'll end up circling back to timing again and really illustrating how we fit into that map that Liz showed earlier on the timing of everything, but an appraisal does not actually have to be completed prior to the gift. So I think that's one thing that's important. Like I said, having all the advisors with a seat at the table from the very beginning is important, but the appraisal itself doesn't actually have to be completed until after the gift. Now, a business owner may say, well, I don't know what my company is worth. If you're selling your company, you likely do. But say you were working with one of the other scenarios. I don't know what my business is worth. I need to understand that before I know how much I want to give away. Then certainly we can come in and do a valuation prior, but the IRS does require that a valuation is done no earlier than 60 days prior to the gift. Typically though, we're coming in and we are valuing after the fact as of the date of the gift. So valuation date is always a really important concept within business valuation, and the valuation date cannot be any later than the gift itself, the gift date. That would become our valuation date in this case. So, circling back to, why would I need to have a valuation if I already know what the value of my business is? And yes, it's because the IRS says that you have to, but there's a few other things to consider. So as an appraiser, we look at all standard valuation approaches, but we also consider the potential deal terms presented in the LOI. So remember that this is not a deemed sale at the point that we are involved. It is an expected sale, and there is a letter of intent in place. And so that letter of intent does represent what a willing buyer and a willing seller would be willing to pay or receive for the business interest, which represents a potential indication of fair market value. And that fair market value is really key here. And I will get into this a touch more in a later slide, but that is one of the requirements of a qualified appraisal, is that it be assessed at fair market value. And that is not always the case when you think about your LOI or your potential sale price. There could be some other things that are considered in that maybe do not represent fair market value. And then there's also the other aspect that the IRS needs to consider discounts. Discounts for lack of control and lack of marketability that are present in privately owned business interest. So I can get into that here. When I look at kind of two different scenarios of where these discounts, we generally see these discounts apply, are on both the estate planning side and the charitable gift side. And there are a lot of parallels here, but when it comes to discounts, they actually have opposite incentives. So estate planning, there's no expectation of liquidity. So obviously that is completely opposite of everything we've talked about today. And because there's no expectation of liquidity, that makes discounts for lack of control and lack of marketability higher. And why? What's the reasoning there? Well, different than, say, a publicly traded stock, there is not an active market to readily sell the stock or the membership interest. And so there are discounts for lack of marketability that are associated with private business interest. That lack of control comes from, most of the time we're dealing with minority interest, and so those minority interests do not have the control to exert in order to liquidate their investment. So oftentimes we see much larger discounts for estate planning than what we do on the charitable gift side. And so on the charitable gift side, yes, we're also working with minority interest, but why we focus so hard on these paths to liquidity is because of how it impacts the discount. And this discount in charitable giving, there's an incentive for it to be lower. The lower the discount off of the fair market value of the stock means you're going to get a bigger bang for your buck in terms of the deduction. So where the opportunities for lowering the discount come from those paths to liquidity. And the one that we've talked about already is a pending sale. A pending sale is a huge potential path to liquidity, even for those minority interests. So one thing here, and I was just going to take a look back at that prior slide real quick, Liz. I wanted to mention here, so we are looking at the put option. So the other path to liquidity here is the put option to sell back. And what that means is that the charitable or the DAF ultimately has the ability to sell that interest back to the giver. And that also creates a path to liquidity that would potentially lower these discounts. So jumping in, liquidity and certainty, and the factors that reduce the discounts, ultimately, why does this matter? The more certain a sale is, the lower the discount. But it can't be a sure thing. So going back to, we've mentioned a few times that the sale has to be contemplated. There has to be a potential for it to still fall through. It can't be a deemed sale. The parties, in order for it to work, the parties still have to have the ability to exit if they chose to. IRS is really keen on it not being a deemed sale. So there's really a balancing act here. So in terms of the discounts, because the closer you are to that potential liquidity event, you're going to lower the discounts, which maximizes your potential for the income tax deduction, and the capital gains tax, actually, for that matter. But you just cannot be too far along in the process. It cannot be a deemed sale.
So it's kind of a balance. You want to be close, but not too close.
Exactly. And even better, the IRS does not give any guidance on what that time frame should be. They just say that it can't be a deemed sale, and they've really shied away from giving any specifics on guidance for what that should be. And I'll share another story here soon, but there has been times where that has not worked out favorably because we've gotten too close to the sale. But so the other paths of liquidity here that's key is that put option. And again, this is why it is helpful to bring in the qualified appraiser into that seat at the table from the very beginning, because there are certain DAFs that we work with where this is a key piece of their gift agreement, that put option, which just means that they can give it back to the giver at any point in time. There's usually some timing requirements for it. So that creates another path to liquidity that we can rely on to help reduce those discounts. But if you're working with a DAF that is not set up to include this put option into their gift agreement, you are missing out on a potential way to reduce these discounts. And it is really important. A few percent on a several $million gift is really impactful. And so if you bring us in earlier on in the mix, we would advise to that, and it's likely something that could be added to the gift agreement, even for those DAFs that do not generally have it incorporated.
Let's go to our third polling question. And Kaylee, then I want to make sure we have some time just quickly to address those insights from lessons learned that you wanted to share with us. So for our third polling question, just a quick review: to optimize giving and tax implications, when should a gift of a business interest be made in connection with a sale? So do you want to be making this gift before or after? Hopefully we've been able to highlight and make the case for being proactive with your planning and making that gift before the sale. In the interest of time, because we do only have about 2 minutes left together, Kaylee, why don't you go ahead and just jump into those insights from lessons learned, because I think this is the most important thing to highlight before we let everyone move to their next meeting.
Yeah, absolutely. I think the biggest thing here is, I want to go to the slide on how timing matters. And just like with anything that's growing in popularity and awareness, there has become more, it becomes more heavily scrutinized. So this is certainly a topic in an area that the IRS is looking closely at. So it's really important to pay attention to timing, and that has a few different implications. So again, pre-planning, why pre-planning is so important, is this whole strategy in general. That's kind of the first timing implication here. But again, going back to, it needs the gift itself has to happen prior to the sale, and you cannot be too close to it becoming a deemed sale. I made a reference a minute ago, but there have been situations that has not been with our clients, but there's plenty of cases, case law that we have seen that ultimately the deduction was disallowed because the sale became, the IRS deemed it a deemed sale. And so it's really important not to get too close to that. Another thing I just wanted to mention is, thinking back to a situation where a company sold at a strategic premium. And so we, having us involved earlier on to educate the client on the process of, you might be able to get a strategic premium on the sale of your company because there's so many other factors involved, but the IRS does require us to value the stock at a fair market value level. So that speaks to, your earlier question, Liz, about, why do we have to get involved? Well, this is why we do have to value it at the fair market value. So setting some expectations around, there might be some differences between our valuation and ultimately what the sale price was. But usually we can have a conversation around that. And as long as the expectations are set, that we are still set up favorably to really have a powerful impact on the charitable giving strategy here.
Yes, and the conversation is so key. We would be happy to schedule a conversation with you if you have a client or if your company has a gift in mind, maybe for a pending gift or a past gift. As Kaylee had mentioned, if the gift has already taken place, that's okay. But the valuation date would be the date of the gift, but we can still come in and perform that qualified appraisal for you and your client after the fact. And so if you would like to have a conversation, we would be thrilled and delighted to have a short conversation with you and just continue to talk about some of these concepts. As we get ready to close, the polling question, the fourth polling question is on your screen. So if you want to have that conversation, this is just a really easy way for you to let us know so we can reach out and stay in touch. And then as we just think about key takeaways, right? Just know your client, know their goals, know their desires. That's a really important part of being an advisor. Kaylee, I think you do this really well, and you do this really well for the whole team. As we talked about, the timing of the gift matters. You want to have the right parties involved, including the qualified appraisal. And Kaylee, I think you just had some thoughts that you had put together around like how the professionals at Adamy can help. We have team members who specialize. You're one of them, and you regularly work with the CPAs, attorneys, and just have a really great way about bringing everyone together and making sure the flow of information happens properly. And that's really important. So as I close this final polling question, I want to just let you all know that we're here for you. If you want to get in touch with us, then we would be happy to have a conversation. A few things in the slide deck that you might enjoy looking at are a couple giving stories, the appendix that we put together that just talks about what to look for in a business valuation professional and what to look for in a business valuation report. So if you have some time just to flip through, I think you'll enjoy that appendix. If you want to get in touch with me, please do through one of my email addresses, or you can email Kaylee or give her a phone call. Her contact information is also in the slide deck. So Kaylee, as we close, is there anything else you'd like to add?
Yeah, first of all, just thank you for including me in this conversation. But, charitable gifts of complex assets can be an extremely powerful tool to, ultimately elevate your giving power and enhance your tax strategies, but it does have to be well done. So I definitely recommend investing in the process up front and hiring professionals that are familiar with the nuances. So if you are one of those professionals that are looking to explore the strategy more, Liz and I both are always open to a conversation, collaborating and just strategizing on overall ideas. So we love to educate, and we love to talk more about this topic. So feel free to reach out.
Awesome. Well, thank you so much, Kaylee. And as we close, of course, we just have the CPE housekeeping items. We would love your feedback when you close the Go to Webinar Control panel. There will be a course survey that will pop up on your screen, and we always read the feedback, and we'd appreciate your feedback there. You can access your CPE certificate in 1 hour from your Corsa dashboard. The program recording will be uploaded this evening, and the slide deck, the handouts are also available on your Corsa dashboard. So I hope that you will join us again soon. Please invite a colleague. Until next time, take care and have a great day.